Yes, the relative rotation graphs is a dynamic scattergram. And what it allows us to do is to see easily lots of data, lots of different charts in one chart. So it's many charts in one chart. So you can literally look at 200 charts, but in one picture. What it allows you to do is to compare things in a normalized way, so apples with apples way, which is not possible if you look at just individual charts. As I say, it's a dynamic scattergram, so we've got historic movements, and we can visualize rotation of securities or sectors or currencies in the markets. Yes, relative rotation graphs is not a trading system. It's a way of seeing the data. Like a chart is not a trading system, it's a way of seeing the data. How you use it is really up to you. And with relative rotation graphs, it depends on your attitude to risk and your aggression as to what point you believe that this trend that you're picking up is going to develop into something meaningful. You could wait longer and then you'll be more right, but you'll be later in your joining in the movement itself. I believe that people do overcomplicate what they're doing, and it's really it's a fault of the fact that they can. You know, they've got the software. It's easy to hit a button and put something on a chart, but really the skill is to have as few different messages that are complementing each other, not duplicating. Duplicating will fool you into thinking it's a strong message, when it's actually the same message twice. And so things like going up or going down is a simple thing to answer, and you might use the MACD or moving averages for that, and using lots of different ways of describing that doesn't make you more right. One way is enough. Going up faster, you might use momentum to measure that, so use one momentum oscillator that you like, for example the RSI, and using another one doesn't help you. And having a trend or not, you use maybe the ADX, and there are other ways of doing it, but don't complicate things. The disadvantage of complicated things is it makes it more difficult to read. You become unsure, uncertain, and really in the end you can be so complicated that in fact you may get this horrible disease which is called paralysis of analysis, and you end up doing nothing at all because it's all too complicated. So I think simplicity is actually a goal. I know a lot of technical analysis, but I myself, in my trading system, there are only 5 indicators in it, and that I think is a triumph. I think there is limitation in artificial intelligence. We have high hopes and high expectations that it will do everything. But it's good at doing relatively simple things well, like heart surgery and things like that, and playing chess. But chess is just a game with a board with a fixed size, fixed set of rules, 2 players only. But dealing in the markets is a much more complicated thing. You've got not 2 players, but 250,000 players, all of whom may make a move randomly in any direction. It's very, very difficult for a computer at this stage to actually make predictions on how these people are going to behave. And so I think they do what they do, simple tasks well, like market making and risk management and pre-trade risk management, that sort of thing, but actually delivering outperformance is yet to be achieved, and the funds that are involved in AI are not actually doing that. Yes, we use in the fund that I manage now, we have 2 different trading strategies, and they are designed to complement each other. This comes from my experience when I ran a very big hedge fund, and then because of its size, we had to have many trading strategies. And we actually had an algorithm to help us allocate money towards the strategies which were profitable. So there was learning in that. What I learned after I left that fund and sold out of the fund and then started my my own fund, was that never achieved anything. All that we did was, when the markets became trendy, we moved our money into trendy methods. If the market became choppy, we moved the money into choppy methods, but basically we followed the condition, we never predicted it. So I've come to the conclusion that you can't predict it. So all that I do is I use two different ones, both of which are profitable in the long run, one of which is trend following, and so it will do well when there's trendy conditions, and the other one is pattern recognition, it's counter trend in nature, and it will do well when the market is choppy. And basically in the end both of them are profitable, but sometimes they lose, but hopefully they lose while the other one's making, and then this one makes when the other one is losing. And if they cancel each other out, this is perfect, because you add together the profits and you subtract the variability, so you get a smoother equity curve, but you've got a steeper equity curve. That's the theory of it, you know, and generally this tends to be true. We have years which are, you know, let's say 2 years ago the markets were very trendy in behaviour, and the trendy system did well. This year it's been a choppy year, and the trendy following system has struggled, and the counter trend system has done well. I can't predict what next 2020 is going to be. The institutional traders are very different in a number of ways. First of all, as a private investor, basically if you lose all your money, it's game over, and that's the end of it. Well, for these people, actually, they get reloaded, and then, you know, provided they haven't done terribly badly, they will still have their job. Also, when they're given money to trade with, the idea is to make money with that money. It's not to protect it or preserve it or anything like that. The job is to put it on the line and risk it, and so losing it is part of, you know, of the process for them. So they're much more aggressive in what they're trying to do, and they're trying to make much more money from the money that they've been given. But in other respects, they're very similar. You know, they've got the same problems. A lot of it's psychological, is to do with the difficulties that all traders face, and they face that. It may be that they're talking about, you know, I've had a bad day, I've lost $5 million. You know, like you might say, I've had a bad day and I've lost £500. But it's the same feeling to them, although magnified by that great amount. So they have the same problems as anybody else. But I do think that they have similar problems, but I think that they're not as different as people think. I would say that the most common mistake that I've seen novice traders make is that they are too keen to trade, particularly early on. In, you know, trading, you can learn it, you can learn technical analysis, but it takes time, and if you run out of money before you've learnt it, it's game over already for you. And I see that happening a lot. People are too aggressive in their trading at the early stages. Trade small. You learn just as much trading small as you do from trading big. Preserve your capital. Learning, it's a long game, and you're going to need it, and you inevitably, when you're a learner, you can be lucky, you can be unlucky, and even if you are lucky, you're probably going to be unlucky later. So don't lose all your money before you've learned. And I have met people, you know, that start off with a decent amount of money, and they start trading, and they're reading the books and learning and becoming better and better, and they've lost so much of their money that by the time they really do master it, they've got 1/10 of what they started with, and so it's very difficult for them to recover even from that state.